Happy Independence Day, folks. This is Steve Memory from Iconic Wealth Management with an educational economic update for July 2019. In this month's video, I'll discuss some of the major headlines that influence markets in June. I will also provide insights into what these developments could mean for you as an investor. Please stay tuned at the end of this video for a required disclosure statement. What a difference a month makes. In May, the Dow rode a 6-week losing streak to a 6.7% loss. The S&P 500 lost 6.6%, and the NASDAQ dropped 7.9%. And if you sold in May and went away, you missed a June rally for the record books. In June, the NASDAQ gained 7.4% for the month, closing just above 8,006. The S&P 500 rose 6.9% to over 2,941, its best June since 1955. And the Dow rose more than 7%, its biggest June gain since 1938. That's 80 years, folks. Now, there's plenty of June to go around, but let's look at the numbers for 2019 so far. Year to date, the Dow is up 14%. The NASDAQ has gained 20.7%, and the S&P 500 finished the first half of 2019 with a stellar 17.4%. Large cap stocks weren't alone in the first half rally. Mid-cap stocks, those are companies with a market capitalization between $2 billion and $10 billion, rose by 15.9%, while small cap stocks, those are companies with capitalizations between $300 million and $2 billion, gained 10.9%. All 11 sectors of the economy increased in price in the first half, with gains of more than 20% for consumer discretionary and technology, while the smallest gains were in energy and healthcare. Now, that's a strong close for the first half of the year, and a surprisingly fast start to what is often a challenging period for stocks, thanks to a reprieve in trade war rhetoric and the possibility of a more accommodating Fed. Now, as June began, the trade war looked as if it would spread to Mexico with the announcement of a U.S. tariff increase on Mexican imports, this time tied to immigration issues. By June 7th, the trade war was over, or at least on the back burner, given that President Trump announced the United States and Mexico had signed an agreement which removed the need for the tariffs. While there's much to be skeptical about, this got the optimists rolling. The Fed fueled investor optimism at their meeting on June 18th by doing nothing. But it was a big nothing, and it involved a change in language that signaled to investors a rate cut may soon be in the offing. Almost as important to certain Federal Reserve tea leaf readers was the dissenting vote to reduce rates now instead of waiting. So does this mean that there'll be a rate cut in the next meeting? No. But it does mean that economists think that the Fed may be thinking harder about easing the money supply. And that was good enough for many investors. By the end of June, concerns about tariffs on Chinese goods had begun to turn into optimism for a favorable trade deal. President Trump and President Xi of China agreed to continue trade negotiations during the G20 summit in Japan. And by June 29th, this optimism was rewarded when the presidents declared that a truce on tariffs had been agreed upon. But as we always say, fundamentals drive the economy. So let's look at the numbers. The third estimate for the first quarter GDP growth was affirmed at a strong 3.1%. But that growth seems to be slowing since the end of the quarter. GDP growth expectations for the rest of 2019 are looking to fall in the 2.5% to 2.7% range. Durable goods orders fell 1.3% in May. But the report showed a rise of 0.4%, when you adjusted for defense and aircraft orders. Now, the Case-Shiller Home Price Index was flat in April, with the year-over-year figure now showing only a 2.5% gain as home price gains continue to slow. Consumer confidence for June was at 121.5. This was also below expectations. Trade and tariffs were the big concerns. Not surprisingly then, consumer sentiment for June dropped to 98.2. That's down from May's reading of 100. So what does this mean for the markets? Well, Friday's GDP report also showed inflation rising a mere 0.5%. This means the Fed does have room to lower interest rates, and lower rates should help extend the U.S. economic expansion. The big variables for longer-term global growth are tariffs and trade wars. The recent suggestion of a positive resolution to the trade war would be a significant boon to the global economy and would likely benefit corporate earnings and, you guessed it, stock prices. The combination of solid earnings per share growth and lower yields on bonds could mean a significant boost to stock prices over the next 12 months. As a result, we remain bullish for the long term on U.S. equities and the U.S. economy. The near term can change with a tweet, and there are still geopolitical uncertainties. The third quarter is notorious for underperforming, with positive market returns only 3/5 of the time since 1980. We'll be keeping a close eye on the Fed, earnings, and the trade war as the summer progresses. But that's it for this month's Educational Economic Update. Once again, this is Steve Memory with Iconic Wealth Management, signing off for the month of July 2019. Please remember that nothing we talk about here is a recommendation. If you'd like to discuss your personal financial situation, please give us a call at 703-891-9518. We'd be happy to talk to you.